We know there are significant challenges within the eurozone, both from an economic but also structural reform perspective. And that's been shining through in terms of the economic data that we've been seeing. Look at growth, still remains anemic. Unemployment still remains elevated, hovering pretty close to record levels, 11.5%. Perhaps most worrying for policymakers, at least in the short term, is the fact that inflation has turned negative during the course of December. We know they're very concerned about a downward spiral in deflation spinning out of control. Now, they have tried to react to those conditions. They cut interest rates. They said that they would buy asset-backed securities. They increased the penalty on commercial banks that park their money at the central bank. The reality is that wasn't enough to reflate the economy, to generate the growth that's required to stimulate and create those job opportunities. So they had to go further in order to meet their mandated inflation target of just below 2%. So they've announced this huge quantitative easing program, saying they'd buy 60 billion euros worth of assets per month, starting in March and continuing that process all the way until the end of September 2016. I mean, that equates to a 1.1 trillion euro stimulus package. What are they hoping to achieve? Well, increase the flow of cash that goes through the economy within the eurozone, improve liquidity conditions in the financial system in an effort to try and encourage lending. We also know that one of the major concerns, I think, for policymakers is the fact that they're worried about yields spiralling out of control within the eurozone. They want to keep long-term interest rates low, particularly for these indebted southern European countries. But the key aspect, you have to argue, in terms of this quantitative easing program, is really to weaken the euro. They weaken the euro, they know demand for European products will increase. Alongside that, they'll start to import some inflation coming through. Will it be effective? Well, we think so. It's likely to re-anchor inflation expectations. It'll help to reinforce forward guidance, and alongside that, pick up growth expectations as well. But it's not the silver bullet. The reality is the eurozone also needs structural reform. It needs to continue on this journey of economic, political, fiscal and banking integration if it's to be effective. So what we're seeing from the European Central Bank saying is we're doing our bit. We've backstopped the eurozone, we've calmed market nerves. Now politicians must do their bit to introduce those much needed structural reforms. Well, we work with captive insurers in Guernsey and around the world, and we know that they've had to adapt to changing market conditions. Traditionally, of course, a captive didn't want to take any risk in terms of the investment portfolio. It was about just generating the returns that they could. So they went to fixed income markets, they went to the safe haven of quality government bonds. But in the years after the financial crisis, those returns diminished quite substantially. So they were forced to look elsewhere across different asset classes. So they went into investment grade, they started to look into high yield. Increasingly, what we've been doing, working with clients, is saying actually there is a possibility of gaining good returns from equity markets, but doing it in a managed and risk-adjusted way. And that's probably one of the biggest changes that we've seen in terms of our interaction with captive clients. I think when you look at the global economy during the course of 2015 and beyond, you're starting to see some winners and losers coming through. I think in the developed world, I think the US will be leading the charge. Had a bit of a tough start to 2014, but momentum was building. I think that will continue into 2015. If you look at the key aspects of the US market, the labour market is very strong. Consumers are continuing to spend. Housing market still remains relatively robust. The nation's finances are in much better shape. The eurozone, I think you've got to be a little bit more cautious about. The European Central Bank trying to stimulate growth, as we've been talking about, trying to reflate the economy once again. Not the years of contraction we saw after the financial crisis. Maybe we're talking about growth of 1%. The real surprise in terms of the global economy continues to be the UK. We had a very strong year during the course of 2014, the strongest growth for 7 years. I think stronger household demand, boosted by lower unemployment, by lower levels of inflation and wages starting to rise, will be a key growth element to the UK economy. Business investment is picking up, construction investment starting to look stronger. If we do see some stability within the eurozone, that'll be good news in terms of exports. In terms of the emerging markets, A lot has been said around the slowdown in China. I don't think we should be too excited about that. China's a much bigger, much more mature economy. Even if it's growing at 7%, that's still very respectable. I think the growth we're seeing from China is starting to become more sustainable. I think we're seeing real changes coming through in terms of India. Now, India's gone through some tough years, but we've got a new government in India. They're mandated to really focus on the economy, to generate the growth that's required, to try and remove some of that bureaucracy. So we expect growth in India to generate 7 to 8% per annum over the course of the next few years. But some of those traditional emerging markets are going to be under pressure. Think about the sanctions in Russia. Think about the slowdown that we've seen in terms of the oil price. That's going to affect their fortunes. That's going to be an area that's going to be in contraction. Think about Brazil as well. Lots of excitement there. We know commodity markets are under pressure. So I think they're going to struggle a little bit. So as you look for the global economy, lots of winners, a few losers out there. But in general terms, we are talking about the global economy growing at a pace close to 3.5% during the course of 2015. Well, I think the biggest question that we get from clients, including captives at the moment, should they continue to invest in equity markets given the strong performance that we've seen over the course of the past few years? And the answer to that is still very simple. I think it's yes, because actually it's the best place for value. Value, of course, in equity markets, not as cheap as where it was just a few years ago. But I think the fundamentals still look very good. If you look at corporate profitability growth, still growing at a rapid rate. If you look for Europe during the course of this year, you're still talking about 10% earnings growth. Analysts still optimistic about what's happening in the United States. Balance sheets still look very healthy indeed. Valuations, well, maybe you're paying 15.5 times multiple for the S&P 500. I think it's a little bit lower in the eurozone, around 13.5 times. So still plenty of opportunities for investors to take advantage of that. In the past couple of years, we've said to clients, in terms of equity markets, it's US, it's US, it's US, and that's where the outperformance has been coming. But actually, we're more optimistic about what's happening in the eurozone. Try to take advantage of some of those beaten up valuations. We know the European Central Bank will continue to be very supportive of the growth that they're trying to generate within the eurozone. That quantitative easing program, what does that mean? The euro, as we said, is going to be weaker. That's going to be helping the big exporters. So we are more optimistic about what's going to be happening in Europe from an economic perspective and from a corporate perspective as we go through the rest of this year. And when you compare equity markets to other asset classes, particularly in terms of fixed income, I think it tells you a very easy story. Valuations incredibly expensive, certainly when you look at quality government bonds. They will have to face up to those traditional headwinds of a recovering global economy, a change in interest rates as we go through the normalisation of policy, likely to start, of course, in the United States. And eventually we'll see a pickup in inflation expectations. That suggests this incredible run that we've seen in quality government bonds is likely to come to an end. We said the corporate picture still remains bright, and we believe that. But the market, I think, is already up to date when it comes to the high yield sector, when it comes to investment grade. So the reality is, as you look through the rest of 2015, the only game in town in terms of outperformance has got to be equity markets.